All right, change number 3. The third change is going to be a change in reporting entity. And what we need to remember here is that this is very similar to what we talked about when we discussed changes in accounting principle. Only now we're talking about a change in reporting entities within consolidated financial statements. Okay, so let's break that out. Let's say that Shark Corp is presenting its consolidated financial statements. And Shark Corp owns 25% of 3 different subsidiaries: Minnow Corp, Dolphin Corp, and Whale Corp. Okay, so changes in percentage of ownership is going to be discussed more when we get into our business combination chapter a little bit later on in this course. Okay, but this is also going to apply now if we have a change in reporting entity. All right, but bottom line is if Shark Corp owns 25% of these 3 subsidiaries, they'll be accounting for the 3 subsidiaries by using the equity method. But again, we'll talk about that more a little bit later in detail. But for now, let's say that in year 3, Shark Corp now has the opportunity to purchase another 50% of Minnow Corp. But what's important to know for now is that at this point, Shark Corp will have achieved what's considered significant influence, meaning they'll essentially have control of this company. But as it applies to accounting changes, what we're saying here is that this is now going to change the reporting requirements for Minnow Corp. They're now going to be applying the acquisition method instead of the equity method. All right, and that's going to impact the consolidated financial statements. Okay, so if there is a change in any of these 3 corporations' financial statements, then it would be a change in reporting entity. Okay, so let's make this easy. Changes in reporting entity are going to be extremely similar, like we said, to changes in accounting principle, meaning we're going to be treating these retrospectively, right? We remember Retro Music Company. Whoa, that's so retro, right? We're going backwards, just like Retro Music Company is going back in time. We're adjusting previous financial statements that are presented. All right, and primarily these questions are going to be presented under the assumption that comparative financial statements are being presented. So what did we learn about comparative financial statements? That just means that we are presenting the current year financial statements along with previous financial statements for this specific company. All right, so if we are presenting a change in reporting entity for year 3, we're going to go back and present the cumulative impact of that change for year 1 and 2 financial statements as well, assuming that we are presenting comparative financial statements for years 1, 2, and 3. All right, but essentially your buzzword here is going to be restatement. We're going to go back and restate prior financial statements. And we're basically taking a change in accounting for Minnow Corp in year 3, and we're restating prior period financial statements to reflect the updates to years 1, 2, and 3. Right, we're telling financial statement readers this is what the financial statements would have looked like had we accounted for Minnow Corp under the acquisition method this entire time.